Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of navigating the opportunities and risks of emerging market bonds in 2024. Thinking of investing in emerging market bonds? You're not alone. These bonds have become a hot topic recently, playing a crucial role in global finance. They offer both high returns and high risks, making them a fascinating choice for investors who want to diversify their portfolios. But what exactly are they, and why should you care? This video will break down what emerging market bonds are, highlight their significance, and explore why they might just be worth a second look for savvy investors in 2024. Let's dive into the potential opportunities and risks they present. What are emerging market bonds? Emerging market bonds are debts issued by countries with economies that aren't yet fully developed, but show potential for growth. These bonds can be issued by governments, corporations, or even state-backed companies within these economies. While they come with enticing high yields, they also bring along a unique set of risks. This section will break down the core characteristics and various types of these bonds, helping you understand their intricacies and decide if they're right for your investment portfolio. Characteristics of emerging market bonds. Emerging market bonds are known for a few key features that set them apart from bonds in developed markets. Here's what you need to know. Higher yields. One of the biggest attractions is the potential for high returns. Investors demand these yields as compensation for the additional risks associated with emerging markets. Credit risk. These bonds come with a higher risk of default compared to those issued by stable developed countries. As emerging economies can be unpredictable, there's always a chance that the issuer may not be able to make the necessary payments. Currency risk. Many emerging market bonds are issued in local currencies. This means fluctuations in exchange rates can significantly impact the bond's value to a foreign investor. A strong dollar can diminish returns for bonds issued in weaker currencies. Duration. Like other bonds, these can vary in duration. However, longer durations can amplify both risks and rewards due to the prolonged exposure to market volatility. Understanding these characteristics is crucial for anyone considering stepping into the world of emerging market bonds. Types of emerging market bonds. When you step into the world of emerging market bonds, you find a variety of types, each with its own distinct aspects. Sovereign bonds. These are issued by national governments. They often come with the highest yields due to the potential economic instability of the issuing country. Yet they can also offer a sense of security if the country's outlook improves. Corporate bonds. Issued by companies operating in emerging markets, these bonds often provide higher yields than sovereign options. However, they carry more corporate-specific risks, including business environment fluctuations and company management issues. Quasi-sovereign bonds. Issued by state-owned enterprises or government-backed entities, these bonds often offer a middle ground. They present higher yields than sovereign bonds, while typically being less risky than purely corporate bonds. Choosing between these types depends on your risk tolerance and investment goals. Each type offers an opportunity to capitalize on the growth potential of emerging economies, with varying degrees of risk and reward. The importance of emerging market bonds. Emerging market bonds have caught the eye of investors seeking both growth potential and diversification. They are more than just high-yield opportunities. These bonds reflect the economic pulse of developing countries, offering insights and investment adventures. Risk and return profiles. Emerging market bonds present a unique risk-return trade-off, setting them apart from other asset classes. These bonds typically exhibit higher yields, enticing investors with the promise of substantial returns. Yet these potential gains come with heightened risks, especially when compared to bonds from developed markets. Credit risk. There's an elevated chance of default. Emerging markets often face economic instability, and this uncertainty can impact a country's ability to meet its debt obligations. Currency risk. Many of these bonds are issued in the local currency. Currency fluctuations can dramatically affect returns, especially when the issuing currency loses value against the investor's currency. Market volatility. Emerging markets are often subject to sharper economic swings, affecting bond prices and yields. Despite these risks, the allure of higher yields can be a strong pull for investors willing to accept these uncertainties. The ability to balance risks with potential returns makes these bonds an intriguing choice for those looking to enhance their portfolios. Economic factors influencing performance. The performance of emerging market bonds is deeply tied to various economic factors. Understanding these can help investors make informed decisions. Economic growth. Strong growth in an emerging market can lead to increased investor confidence, potentially boosting bond performance. Rapid industrialization and infrastructure development often play crucial roles here. Inflation. Inflation can erode real returns on bonds. If inflation rises beyond expectations, it often leads to tighter monetary policy, which can negatively impact bond prices. Geopolitical stability. Political events and stability in a country dramatically affect investor sentiment. Geopolitical risks can create uncertainty, impacting bond yields and investor confidence. These bonds offer a lens into the economic conditions of developing nations. Monitoring these factors can be akin to watching the weather pattern on a distant shore, where shifts can ripple through global markets. These dynamics are pivotal, shaping how emerging market bonds perform over time, making it vital for investors to stay informed and prepared. Major emerging markets for bonds. Exploring the major emerging markets in the bond sector unveils a world of potential and risk. As economies strive for growth, their bond markets provide unique opportunities for investors searching for higher yields and diversification. However, these markets come with their own set of challenges and uncertainties, making it essential to tread carefully and stay informed. Brazil and Mexico. Brazil and Mexico are vibrant players in the world of emerging market bonds. Both nations offer rich potential but carry inherent risks. Brazil's bond market. Growth potential. Brazil boasts a wealth of natural resources and a large domestic market, a combination that provides a foundation for economic growth. This growth potential is reflected in its bond market, which regularly attracts foreign investors. Risks. Political instability and economic volatility are two challenges facing Brazil. In the past, fluctuating interest rates and inflation have affected returns, creating an uncertain investment climate. Plus, Brazil's currency risk can be substantial, especially with exchange rate fluctuations impacting bond valuations. Mexico's bond market. Growth potential. As one of the largest economies in Latin America, Mexico offers significant opportunities, especially with its manufacturing capabilities and proximity to the US. This geographic advantage often draws investors seeking exposure to the emerging markets. Risks. Mexico isn't immune to political and economic risks. Policy changes or instability can impact the bond market, and like Brazil, currency fluctuations can pose a threat. Additionally, dependence on the US economy implies that economic slowdown north of the border can have a ripple effect on Mexico, India and China. The bond markets in India and China are witnessing transformation, offering distinct opportunities for global investors. India's bond market. Foreign investment opportunities. With reforms aimed at liberalizing its economy, India's bond market is opening up to foreign investors. The government's focus on infrastructure development is spurring economic growth, providing a promising backdrop for bond investments. Risks. Despite its potential, India's bond market isn't without challenges. Regulatory changes and bureaucratic complexities can present hurdles. Moreover, socio-economic factors and political risks remain areas to watch closely. China's bond market. Foreign investment opportunities. As the world's second-largest economy, China's bond market has been expanding, supported by domestic reforms and global connectivity initiatives. The inclusion of Chinese bonds in global indices has made it a hotbed for foreign investment. Risks. Investors should be wary of China's regulatory environment and state-driven economic policies. These can influence market dynamics in unexpected ways. Moreover, geopolitical tensions and trade relationships can impact investor sentiment and market stability. In these markets, carefully weighing the growth potential against associated risks is crucial for investors. Keeping an eye on economic reforms, geopolitical changes, and currency fluctuations can make all the difference in strategizing bond investments effectively. Investment strategies for emerging market bonds. Investing in emerging market bonds offers a chance to diversify your portfolio and tap into higher yields. But how do you decide between direct investments or taking the fund route? And should you trust active managers or opt for passive strategies? Let's explore these strategies to make the most of your investment. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.